In this video, we're going to take a look at central banks. And central banks, I'm not going to give the definition here in the notes anyways, because I assume you remember, these are the financial institutions that are responsible for maintaining the financial system kind of as a whole in terms of regulations and things like that. But in particular, they're responsible for maintaining the money supply and regulating it. So monetary policy is money policy is another way to think about it. It's policy related to the money supply. So the three tools that we'd say that central banks have are reserve requirement changes. We'd say they can change the discount rate changes, right? And we could say they could do open market operations, which would be buying and selling bonds. Now, how does changing the reserve requirement change the money supply? Well, if the central bank cuts the reserve requirement, then we're going to say, and so this is like one direction of this, but you could imagine that it could work in the reverse as well. If they raise the reserve requirement, everything else goes in the opposite. If the central bank cuts the reserve requirement, banks can lend out more money. And if banks lend out more, then the money supply gets bigger. So we'd say that everything else kind of works in reverse. If they increase the reserve requirement, then the opposite happens. How does changing the discount rate change the money supply? So this kind of relies on knowing what the discount rate is. If the central bank raises the discount rate, banks are less likely to, I'll get rid of that, we don't need that update, less likely to lend out money. Now, understanding the discount rate, this is the rate the central bank charges for loans to banks. So this would be when a bank needs money, right? And it's like, geez, we can't cover our requirements. We really need to have a little extra cash. They could go to the central bank. Now, if the central bank makes the discount rate really, really high, it makes it very expensive for banks to borrow from it in an emergency. And so banks, if the central bank makes the discount rate really high, banks are less likely to lend out money because they don't want to have to borrow from the discount window at a high rate. So that's kind of the explanation for why that is true. And then the last one, if that happens, then money supply is smaller. And then the last one is buying and selling bonds. If the central bank buys bonds from banks, then banks have more reserves to lend out. And if banks lend out more, then the money supply gets bigger. This is by far and away the most important one, right? This one's really, really important. And the easy way to remember it, I'll just kind of put it on here, buy bonds bigger and sell bonds smaller. And that bigger and smaller refers to the money supply. Now, we've already defined the discount rate actually already, C number 3. And then the federal funds rate is another type of interest rate to be aware of. It's the rate that banks charge each other for short-term loans. And this is actually the rate. This is the rate that the Fed or central banks target when they try to buy and sell bonds. So they basically say we want the interest rate to be 2%, or right now the Fed has set the interest rate to be 0%. And what they're talking about is the federal funds rate in that discussion. Okay, now let's return to that balance sheet that we looked at once already, and we'll talk about if the Fed buys $50 of bonds from the Bank of Clayton. And in this one, how much did the money supply change initially? It increased by 50 because they added 50 to reserves. Now, the one way to think about this would be is that maybe M1 didn't change, right? But there's literally more monetary base because now the Fed bought bonds and they credited it with more $50 in reserves. How much could the bank loan of this purchase, right? So be careful with questions the way they're worded. We're not asking about how much could they loan of this 30, it's of that $50. And the bank could loan out all 50 because there's no reserve requirement on it. It's only the required reserves apply to demand deposits. How much could the money supply change in maximum? Well, we already figured out the money multiplier was 5, so 5 times 50 is 250. And then the maximum change in loans is always that same value. So hopefully this helps you make sense of balance sheets and central banks and the tools of the Fed. Hopefully this helps you. I'll see you next time.